Good morning, ladies and gentlemen. Well, the dot plots are starting to bite after those NFP figures showing basically what is stagflation. We are getting slower growth and higher wages, which are dampening the possibility of a consumer-led recession. We're still getting no job losses, and therefore higher for longer seems to be the order of the day, and negative carry for as far as we can see. And therefore the market is beginning to get upset, and when bonds get upset, all assets get upset. In the 1 year note, we've reached levels that basically are discounting the dot plots of 560, because we also have some expectations of easing in 2024. Those could easily be taken out and we could even go up towards 560, but from here we are within 10 to 15 basis points of the top. And that is also now keeping the 2 year note from accelerating much higher. I think the likelihood of the dot plots for 2023 being moved up is not great. But what the market could start discounting is far less easing than is priced in already for 2024 and 2025, i.e. a more gradual easing. And therefore the 2 year note certainly can keep on going up towards at least the 5.25 to 530 level, in my opinion, i.e. new highs for the year. And what could easily happen is, after even a weakish CPI that tests something like 475, we could then start getting the move higher. I am certainly going to be a seller on a weak CPI number, on a miss in CPI, because the likelihood is that June, because of base effects rather, is going to be the trough of real inflation, of core inflation rather, for 2023. And any kind of a rally in prices in 2s, 3s, 5s, I'm a big seller of. If we look at the 5 year note, you can see how that is beginning to take out 2023 highs. And I have no doubt that we will retest the 448. Nobody likes this negative carry forever, and we need to price in this negative carry. And to me, my calculations, we are talking about higher levels than this. We're talking 480s, 490s. 10s, I mean, next week rather, we have 3s, 10s and 30s. So I think the pressure stays on. And any kind of retest of this 390 level, I'm going to love to look to sell for something like 428. The 30s, I think there is no doubt that we will also trade this 419 level and maybe a little bit higher. The fact that we are taking out this whole range for the whole of 2023, and we've had the highest weekly close and daily close, indicates to me that the pressure is going to be sustained, maybe from lower levels if we get a miss on CPI on Wednesday, but this is no way over. We are going to be trading 430s and higher in all of these. If we actually have a look at the yield curve, the 2s, 10s came off simply because, as I told you, what's happening is that we are not going to out-hawk the Fed, having reached more or less the dot plots for this for 2023. And therefore the 2s, 10s are now going to be somehow compressed. The 5s, 30s, on the other hand, can still push up towards the 433 level, and maybe even the 60 level. And the 10s, 30s, this is a technical trade. I think that if we retest these gap levels around -3 to -6, that is probably going to be as far down as it goes. And you know that 10s, 30s doesn't like to stay negative. But after that, we will probably retest this 6th level. It's all going to remain compressed here with slight tendency overall to flatten. But I don't think the flattening tendency in 10s, 30s is going to be as powerful as the flattening tendency in the 5s, 30s. So next week, if we see a rally in the bond market, 5s is the area to sell. The German market is half asleep, isn't it? It's summer. We've reached the levels in the Schatz, retesting the highs of the year. I think it's likely to just range trade from now, and same really for the bubble. It really is not going up very much or down very much, but I think 285 will be seen, definitely tested. And the longer end, this is now the Bund. As you can see, it's not looking happy. It's taken out a very large area, and I would have thought this on top of this basically gives us 290 at some stage without any problem, just below 3%. I think the ECB is going to have to accelerate the hikes, and therefore in no way am I a buyer until I see at least this 290 to 3%, and I think we're definitely going to see it. In terms of differentials between Germany and the US, as I've been saying, these levels are difficult to penetrate. It's quite likely, it's possible that we go up towards 180 as if CPI is bad, but I doubt it. I think it's going to be a great sell. This is twos, i.e. Schatz against the 2-year. I think the 2-year has done a lot in both the US and in Germany, so that relationship should remain quite stable. 5s are having great difficulty around this 160 area, and certainly 174 is a massive sell. The way I prefer to trade this is that if we get to that level, then I just short Germany, because Germany becomes rich. And I'm just a short in the bond market, whether it's Germany or whether it's the US, depends on this spread where we are here in this range. Because I don't think that we go below 135 for the time being, and I certainly don't think that we go above 175. So at the higher end of this range, I short Germany as opposed to the US. And if we have a look at the 10s, I kept on saying around this 142 level, 143, and as you can see, just finding it very, very hard to break. But if we get towards this 152, I will be a seller of bunds outright, as opposed to thinking about selling 10-year notes. And if we look at the 30s, as you can see, that just can't go above 147. So same story here. As that spread goes out, I'm just a seller of Europe outright, as opposed to trying to play the spread. I know that the bond market's all going higher in yield, and therefore you're just looking for the one that is going to give you the biggest bang for your buck. Given that the 10-year, 30-year, whatever you like to look at in terms of interest rate differentials, is not really moving, the fact that the dollar is quite weak is really quite surprising to me. but it certainly looks like this formation reestablishes some sort of a weakness. We are not particularly weak. It's just that it's just a complete struggle to the upside in DXY, and therefore I would have thought this 101.10, 101 area could easily get retested next week. Naturally depends on CPI and the differentials. I don't think it goes a million miles. I think that 1%, 1.5% difference between where we are now and this 101 is likely to be the most you see. But that is, the fact that it's weak when it shouldn't be tells you that the direction of travel of DXY, the easiest way for the market to push it is down. In terms of Euro USD, that equates to around 110.60. That's the kind of level that you're looking over the course of the next few days, and if it goes through it, so what? But that definitely seems the way of it, and really it has more to do with the yen than anything else. I think the yen has reached levels that people are now afraid what the BOJ might do. And that is another reason why bonds are unlikely to rally or sustain any rally, rather. And that is why this kind of formation in the DXY tells you, or rather Euro USD here, tells you that you're more likely to see 110.60 than weakness down below 108.60 with this moving average. Certainly that seems to be a weakening, a slow weakening of the dollar seems to be the easiest trade at the moment. Gold seems to be stuck. The dollar is weakish and the bond market is hawkish. And therefore that is basically keeping gold steady. It's being pulled in both directions. It can't touch this 1881 level that I would love to buy it at, and it just can't rally above 1959. Basically, as I said, it's being pulled in both directions, and I would have thought a period of trading more stability is more likely than not. But the odds are turning for the upside again, simply because if the bond market is now going to be hawkish, i.e. its rates are going up because inflation is bottoming for the year, then gold has an additional reason to rally. So it seems that 1890s, 1880s are definitely as far down as it's going to go. And the fact that this 200-day moving average is supporting it, to me, is significant. Below 1880, I don't want to know about gold. But while it's maintaining it, I think the odds are that it goes back up and trades 1959. DBC, absolutely nothing to see here, completely stuck. But slowly, it's beginning to look more like, especially if we look at oil, which is its main component, like it's basing. And it's still trading below the moving average. But if we just can't break lower into the area that would love to buy it, which I showed you in previous videos is going to be the 57 to 60 area, if we now start closing above 75.16 and taking out 2-3 months worth of range trading, and we start breaking above the moving average, the 200-day moving average, that will be another reason to suspect that we have definitely reached the lows in inflation for the year, get more hawkish on bonds, and get positive on commodities. It's not happening yet, but the fact that we just can't break the 200-week moving average on the downside tells me that things might be changing. It's early yet, but I'm keeping my eyes on it and I'm keeping an open mind. I wanted to show you the Blue Angels before I start discussing equities, because I think we could be near a turning point down, and I'll tell you why. It's very difficult to believe that if long bonds go to 4.25, you don't get a bit of a compression in multiples, whatever earnings are. And we're going into earnings season very shortly, and the Blue Angels have turned basically flat. I find it very difficult to believe that we're going to go to times 20 if I am correct and the bond market stays hawkish. But we will know more about that on August the 2nd, when basically Janet Yellen announces the composition of the issuance of the bonds for the third and fourth quarters. I just think it's far more likely that we test the downside than the upside through basically a multiple compression rather than an earnings recession. I don't think we're going to get an earnings recession. We could get very decent earnings, and basically the stock market goes nowhere on it because of the hawkishness in the bonds, if I'm correct about the hawkishness in the bonds, and I think I am. In which case, you are much more likely to see this 4,200 level, which is times 18, than you are likely to see it go higher. But I think options are so cheap that that is the way to play it. Having seen the Blue Angels, I think that what happened in the last hour on Friday is quite significant. If we have a look at what happened last sort of week, even though it was shortened, what we did is we opened lower and then we basically tried to fill the gap all week. And we got there on Friday in the first half of the day, and then boom, straight back down. If there's any weakness in the early part of next week, we are far more likely to come all the way down and fill this gap than just stop here. That's going to be the first stop, 42.36, that kind of area in SPX. But eventually, I think we are quite likely to go down into the low 4200s. And especially if we have a look at my clean chart, as you can see, there is very little support between the this level here of 43.84 and 42.55. It tends to be, if you look at all these past events, it tends to be very volatile between those points. And that is another thing which gives me pause for thought in, could we get a bit of a violent move down simply on multiple compression from the bond market? I think the odds of that are now increasing. And, you know, if you have something like a 43.25, 4,200 option on for 2-3 weeks, even 1x2, I don't, you know, the cost is going to be negligible, and I think you could make quite a bit of money. Naturally, for that move to occur in SPX, the Nasdaq has to allow it. And if we say that this is the wave, and if we have topped out, then, you know, this kind of retracement around 14,300 and the 0.382, 13,913 becomes quite logical. I really don't see that that would actually negate any of the rally that we've had in the Nasdaq this year, and I think it would be quite healthy as well. So I think the Nasdaq has an opportunity to allow it. Whether it will or not is something completely different. But I'm just looking at these charts and looking at the Blue Angels, and it's beginning to make sense that the market should allow some give up here in the short term, maybe just to reload. But to me, what makes most sense is that these markets retrace slightly, come back to the times 18 multiplier, and then are probably ready to go up again. As I've been saying for a few weeks now, if any market is going to lead us down, if any equity market is going to lead us down, it's probably going to be Europe. And I think it's beginning to allow us. We are now back to where we were at the beginning of March in SPX, in stocks. And therefore that should allow slowly for the SPX to do something similar, and with the multiple compression go back down towards times 18. Makes sense to me from a fundamental standpoint and also from a technical standpoint. So we have that possibility. Whether the market takes it or not is another thing. But again, as I said, options are so cheap, and I'll discuss that with you next week, that really not putting it on seems to be, it's giving you 5 to 1, 6 to 1. The odds seem good. And VIX basically has taken out all the June lows where it was trading in June, and actually closed right at the top of this correction in June. Slowly, that should allow, even if it goes up to 2021, that will allow that move to 4100, 4200 that I'm talking about. So technically, nothing will have changed if that happens. It's just that the market basically gives up its excess and gets some people all bearsed up at the lows, and then is ready to go again. But everything that I'm looking at allows for the possibility that that happens in the next 3 or 4 weeks. And with that, onto my levels. As I said earlier, I think any kind of move on CPI that is higher in price, lower in yield on bonds is a sell. We have the distinct possibility that we are troughing out on inflation for the year, and therefore I think the bond market is going to remain hawkish. It might do absolutely nothing Monday and Tuesday and probably just range trade and correct the overboughtness in terms of rates and oversoldness in terms of prices, ready to move on CPI Wednesday or PPI. But certainly I think the bond market is making a statement here that it wants to trade higher in yield, and that therefore compressions in the equity market in terms of PEs are quite possible. All the levels are here. I think this kind of move is quite likely, and if the stocks leads us, then 43.27 is the absolute minimum I would expect in SPX. And if we get down into the 4200s, that would next week even, that would not be surprising at all, because I showed you how volatile the market can be between those levels. Once it starts breaking into the 40, below 43.27, it can go quite fast. In any case, as I told you, I'm away Monday, Tuesday. I'll be back Tuesday afternoon, and I will tweet you then. Have a wonderful weekend.